You're more of a sort of financials balance sheet analyst, and that's why you like GE, particularly because you think people got too concerned about the risk of its cash flows, its balance sheet failing.
Yes, that's right, Wilfred, and good afternoon. Thank you for having me on the show. And as you say, I'm a financials analyst and looked at GE Capital, their finance subsidiary. And while GE Capital certainly does require additional capital and likely has a negative valuation, we think at this point investors are over-discounting the risks. And to support that, I'll note the Wall Street Journal article that came out a day or two ago talking about the need to raise $25 billion of equity by issuing new stock in GE. And when we look at that number, we think it's unrealistically large. We think that the equity that is needed is less than half of that number, and it can be raised through the existing plan that GE has to separate GE Healthcare, and in particular to do an IPO of a portion of the GE Healthcare business, somewhere between 20 and 50%. And that IPO could raise anything from $7 to $17 billion, which we think will be more than enough to meet the capital needs of GE Capital and of the firm more generally. And I think once that deal gets done, investor concerns about capital will decline and the stock will trade much more healthily.
Graham, you're skeptical. In fact, GE Capital, in your eyes, is one of the red flags.
Yes, it's a little unfair putting me up against Howard, who is a close friend and one of the smartest analysts I've worked with. So if he's got something to say about GE Capital, I actually want to read it. But it is one of my concerns because it is something that the new CEO, Larry Culp, has not spoken about. He's spoken in details about other businesses. There's this rumor that they're selling GCAS for a large sum of money to try and shore up the balance sheet. There's no doubt that there's bears and bulls on the subject of GE Capital, but I sort of refer to it as the Donald Rumsfeld stock at this point. It's the unknown unknowns that are going to trip us up here with GE. And I wouldn't be surprised if there were another couple of pieces of bad news, not necessarily related to GE Capital, before the deck is completely cleared. And, you know, the stock has improved as the year has gone on. Part of that's because there was a lot, I think, of heavy tax loss selling at the end of last year. So we've seen a rebound from that. But until the company talks about GE Capital, you know, perhaps confirming Howard's view, I think the uncertainty will remain.
Howard, if the balance sheet is a manageable issue at this point, as you lay out there, what's the next step in terms of really arriving at a sum of the parts valuation for this company, whether the various pieces are held or sold or otherwise divested?
Well, there are two core uncertainties around GE. The first is how big the balance sheet hole at GE Capital is. The company has said that they'll put in at least $3 billion in 2019. I think it's going to be closer than $5 billion. And it's likely that there are tail liabilities associated with the long-term care insurance book. So that's one source of uncertainty. And of course, the second source of uncertainty is what a normalized free cash flow for the power business looks like. Clearly, there are some secular headwinds associated with the shift in the energy mix from gas to renewables. But there are also some shorter-term issues. I think GE probably brought forward a little bit of earnings in the power business as it tried to meet some overly aggressive EPS estimates. And I think we're in the lee of that, causing the numbers to be suppressed. Given those two sources of uncertainty, what we really need from GE is guidance. And of course, the new CEO, Larry Culp, has acknowledged the importance of providing guidance, has said that he will provide guidance. But when he last spoke to investors, it was just not the time to do it. So I think we'll see some guidance. If not, when GE reports at the end of January, then by the end of the first quarter or second quarter. And that is the point at which investors can start to get more comfortable with some of the parts valuations and earnings-based valuations.